If you are over the age of 60 and you have money sitting in a bank account right now, I need you to stop scrolling and watch this entire video. Because what I am about to share with you is something that the overwhelming majority of retirees in America have never been told. Not by their bank, not by their financial advisor, and not by the IRS. And the silence around this topic is costing real people real money every single year. We are talking about a federal rule tied to a $10,000 threshold that sounds simple on the surface, but has destroyed the financial peace of mind of thousands of perfectly honest, hard-working Americans who did absolutely nothing wrong. They just did not know. And after today, you will. Welcome. And if this is your first time here, this channel exists for one reason: to make sure that you have the information that protects you, your family, and your retirement. Today's topic is one of the most important things we have ever covered on this channel, so stay with me through every single minute of this video because I am going to walk you through exactly how this rule works, why it catches so many innocent people off guard, and most critically, what you need to do right now to make sure it never becomes a problem for you. I also want to tell you about a woman, a retired school teacher, whose story genuinely stopped me cold when I heard it. I will get to her story in just a few minutes, but first let me lay the foundation, because once you understand how this rule actually operates, everything else will click into place. Let us start with the basics. Under federal law, every single bank in the United States is legally required to file a report whenever a cash deposit exceeds $10,000. This report goes to a federal agency called FinCEN, the Financial Crimes Enforcement Network, which operates under the U.S. Department of the Treasury. The report is called a Currency Transaction Report, or CTR. And here is the first thing I want you to understand clearly and completely. That report is not an accusation. It is not a red flag. It is not the beginning of a criminal investigation against you. It is simply a record, a paper trail. Banks file millions of these reports every single year, and the overwhelming, staggering majority of them result in absolutely nothing. So if you have ever made a large cash deposit and your bank filed one of these reports without telling you, please do not panic. That alone means nothing. You did not do anything wrong. That part you do not need to worry about. The part you do need to worry about, the part that keeps tax attorneys employed and has blindsided retirees from Florida to Oregon, is something entirely different. At some point, information about this $10,000 reporting threshold started spreading through communities, through family dinner tables, through well-meaning friends who thought they were helping, and the advice sounded logical. It sounded careful. People started saying things like, if you deposit $900, the bank won't file a report. If you split it into 2 deposits a few days apart, you fly under the radar. Have your spouse deposit half at a different branch. Keep each deposit just under the limit and you stay invisible. Here is the brutal reality that most people do not know until it is too late. That advice, that careful, cautious, trying to be smart advice, is actually a federal crime. It has a name. It is called structuring. And the truly devastating irony of it is this: it does not matter one single bit whether the money is completely clean. It does not matter if you earned every cent of it over 40 years of honest hard work. It does not matter if you paid taxes on every dollar. The moment you deliberately break up a deposit specifically to stay below that reporting threshold, you have committed a federal offense. People have had accounts frozen over this. People have lost thousands of dollars in asset forfeiture proceedings, and almost none of them believed for even 1 second that they were doing anything illegal. They thought they were being smart. They thought they were being careful. They were wrong. Now I want to slow down here because I know that might sound extreme. You might be thinking, surely the government would not go after a retired person just for splitting up a deposit. And here is the honest answer. You are right that federal prosecutors are not sitting around hunting for retirees to charge. But the automated banking systems that flag transaction patterns do not know you are retired. They do not know you are 72 years old and have been saving money honestly your entire life. They see a sequence of deposits that all land just under $10,000 made over a short period of time, and the algorithm flags it. From there, it goes to a human review. And once it goes to a human review, you now have a situation on your hands. A situation that is stressful, time-consuming, potentially expensive, and completely avoidable if you know the rules in advance. Let me walk you through the 3 most common scenarios where this issue comes up specifically for retirees in 2026, because each one has a slightly different shape and each one has a specific easy solution that takes almost no effort once you know what to look for. The first scenario involves selling something. Maybe you sold a car that has been sitting in your garage for a decade. Maybe you sold some personal property, furniture, tools, jewelry, land, a private sale for cash. The buyer counts out $11,000 in your kitchen, and you drive to the bank and deposit it. Your bank files a currency transaction report. Your name is now on a federal record. And I want to say this again clearly. That is fine. That is completely fine. A report being filed does not mean anything is wrong. The mistake happens in the parking lot or that night at dinner when someone who means well suggests that next time you should have kept it under $10,000 to avoid the hassle. And so the next time you have cash, maybe from a second sale, maybe from something else, you start splitting it. $8,000 one week, $3,000 the next, just to keep things simple, just to avoid the hassle. And that decision, that one well-intentioned decision, is what turns a completely clean situation into something investigators actually pay attention to. What you do instead is genuinely simple. You deposit the full amount in one single transaction. Every dollar all at once. Yes, a report gets filed. That is fine. What actually protects you is the documentation. You keep the bill of sale. You keep the title transfer if there is one. You keep your deposit receipt. If anyone ever asks you anything about that deposit, which is unlikely but possible, you reach into a folder and hand them a piece of paper that tells the complete story. Conversation over, case closed. The second scenario involves family, and this is the one that catches people emotionally off guard because it involves people they love trying to help them. Your son sells a business and wants to give you some of the money. Your daughter wants to cover your medical bills. A grandchild wants to contribute to your living expenses. Whatever the situation, family members trying to help often make the problem worse without knowing it, because the moment you tell them about the $10,000 threshold, and it comes up almost every time, they start offering to break it up. Send it in smaller wire transfers, they say. Have you deposit some and your spouse deposits some? Spread it across a few weeks so the bank doesn't make a fuss. Every single one of those suggestions is structuring. And what makes this particularly serious is that it can expose multiple family members simultaneously, not just the recipient. The person sending the money and the person receiving it can both be implicated if the transaction pattern looks deliberate. What you do instead is simple. Deposit the full amount in one transaction. If it comes by wire or by check, there is already a clean and transparent paper trail and you are essentially done. If it is cash, you go to your bank, you tell the teller it is a family gift, and you deposit the whole amount. The single additional step that gives you complete protection is something called a gift letter. And before you imagine something complicated involving lawyers and notaries and legal language, stop. A gift letter is a piece of paper signed and dated that says something like, "On this date, I gave this person this amount of money as a personal gift with no expectation of repayment." That is it. That letter combined with your deposit receipt is all you need. It closes the story completely and permanently. Now, I want to get to the third scenario because this is the one that truly reveals how unfair and how invisible this trap can be. Before I explain it, I want to tell you about the retired teacher I mentioned at the beginning of this video. Her name is not important, but her situation is. She was 69 years old, a widow. Her husband had passed just a few months before, and she was in the middle of trying to get her financial life organized while simultaneously grieving one of the most significant losses a person can experience. She and her husband had maintained accounts at 2 different banks over the course of 30 years. She wanted to bring everything together into one place, one bank, one account, one manageable picture of what she had. So she started moving the money. She did it in pieces, not because she was hiding anything, not because anyone told her to stay under a threshold. She was exhausted. She was overwhelmed. She was a woman in grief, trying to do one practical task at a time, and moving smaller amounts felt more manageable than dealing with a large and complicated bank transaction during the worst period of her life. 6 weeks later, she received a letter asking her to explain the pattern of transactions in her account. Not a phone call, not a gentle conversation with her branch manager. A letter because the bank's automated system did not know she was grieving. It did not know she had been a school teacher for 34 years and had saved that money one paycheck at a time. It saw a series of deposits, each one landing under $10,000, repeated over a short window of time, and it did what it was built to do. It flagged the pattern. That is the moment that breaks your heart when you hear it, not because what happened to her was catastrophic, but because she had done absolutely nothing wrong. She was just a woman trying to survive something terrible, and the system treated her like a suspect. So let us talk about what the right move looks like when you need to consolidate or move your own savings between your own accounts. Move it in a single transaction. Use a wire transfer or a cashier's check. Clean, traceable, done in one shot. If a teller asks where the funds are coming from, and they may ask, your answer is one sentence. These are my personal savings being transferred from my account at another bank. You do not need to elaborate. You do not need to explain your entire financial history. One sentence. What you keep for your records is a bank statement from the originating account showing the balance before the transfer and your wire confirmation or cashier's check receipt. If the money came from a certificate of deposit that matured, keep that maturity notice. These documents take 5 minutes to gather, and they protect you for the rest of your life. Now, let me talk about the broader protection strategy, because individual transactions are one thing, but your overall financial posture is another. The single most important thing you can have in any situation involving large sums of money is a document that explains the origin. Where did this money come from and why is it moving? A bill of sale, a gift letter, a transfer record, whichever one applies to your situation. Without that document, you are a person with a story. With it, you are a person with evidence. And in any situation involving a government agency or an automated banking system, evidence wins every time. The second layer of protection is a bank statement from the source, because the first question anyone will ever ask you is not what you deposited. They can see that the first question is where it came from before it got to you. If your answer is a document rather than a verbal explanation, the conversation typically ends right there. The third layer is your transfer confirmation. Your wire receipt, your cashier's check stub, whatever physical record exists of the transaction. Keep it for at least 3 years. It takes seconds to file it away, and it could save you enormous amounts of stress down the road. The fourth layer, and this one is critically important and almost never discussed, is making sure that your tax return tells the same story your bank records tell. If you sold property or personal items for cash and deposited the proceeds, that sale may need to appear on your tax return, depending on the amount and the gain involved. When your bank records and your tax return align and tell a consistent story, there is nothing for anyone to investigate. The paper trail is complete. There are no gaps. There is nothing to chase. And the fifth layer applies specifically to the rare situation where someone does reach out. Whether it is your bank, a government agency, or anyone else with questions about a transaction, Answer once clearly with your documents in front of you. Do not over-explain. Do not volunteer additional information that was not requested. Do not call back the next day with more details because you were nervous and wanted to fill in the silence. One clear documented answer is your protection. If it ever goes beyond a routine question, if it starts to feel like something more serious, stop talking immediately and contact a CPA or a tax attorney before you say another word to anyone. Let me address 3 beliefs I hear repeatedly that are genuinely dangerous because each one creates a false sense of security. The first is, if I just keep it under $10,000, I am safe. You are not. You are actually more exposed. A deposit of $9,900 is one of the most consistently flagged amounts in the banking system, not because of any single rule, but because pattern recognition software is specifically trained to identify people who appear to know about the threshold and are attempting to stay below it. Repeated deposits that land just under $10,000 are not invisible. They are a signal. If your amount is $11,000, the correct move is to deposit $11,000 all at once. The second dangerous belief is, this only happens to people who did something wrong. It does not. The system is automated. It has no knowledge of your character, your history, your age, or your intentions. It identifies patterns and generates reports. Entirely innocent retirees receive letters and face reviews every single year, not because they are criminals, but because a transaction they made looked like a pattern that the software was trained to flag. Your integrity does not protect you. Your documentation does. The third belief is, I am retired and on a fixed income, so the IRS is not interested in me. There is no age exemption in federal banking law. There is no retirement exemption. A 74-year-old depositing cash is subject to exactly the same reporting requirements as a 35-year-old small business owner. Your age is not a shield. What you keep on file is. Here's what I want to leave you with as we wrap up today. This rule exists for a legitimate reason. It was designed to identify serious financial crime, money laundering, drug trafficking, tax fraud at scale. It was never intended to be a trap for retired people who sold a vehicle, received a gift from a child, or moved savings after losing a spouse. But the trap catches people regardless of their intentions because the system cannot see your intentions. It can only see your transactions. You are not in that vulnerable group anymore. You now understand what the rule actually is. You understand what triggers a real problem, and it is not making a large deposit. It is breaking up a deposit deliberately to stay below a threshold. You understand what documentation protects you and why it matters. And you understand that the single most damaging thing you can do is follow advice that sounds careful but is actually illegal. Here at U.S. Immigration Intel, we cover the topics that matter most to your financial life and security. Topics like this one that most channels never touch because they assume you already know. If this video gave you clarity today, please take 2 seconds and hit the like button right now. It costs you nothing, and it tells the algorithm that this information is valuable and deserves to reach more people who need it. Leave a comment below and tell me which of the 3 scenarios I covered today is most relevant to your situation: property sales, family gifts, or moving your own money between accounts. Your comment might become the foundation of the next video we make because the questions you ask tell us exactly what you need next. And if you have not subscribed to this channel yet, this is the moment because the next video we are releasing covers another area of retirement finance that almost nobody explains clearly, and it directly affects how much money you actually keep in 2026 and beyond. Hit subscribe and make sure the notification bell is on so you do not miss it.